Over 6% of subprime car loans are now 60 days delinquent. People are behind. This is the worst in more than 30 years. This is worse than what we saw leading up to the Great Recession. Americans owe a record $1.69 trillion on their vehicles, and the average new payment just passed $800. So when you start talking about over 6%, but you take into fact that there's well over $1 trillion in debt out there, that's a lot of money that banks are now taking on as far as unpaid debt. Here's the full story, and I want to tell you or show you how you may be exposed to this, even if you own your car outright.
It is a 6:15 in the morning, and you are standing in your own driveway, holding a cup of coffee, looking at an empty rectangle of asphalt. The first thought is never the right one. The first thought is that you parked on the street. Then you think somebody stole it. You are already reaching for your phone to call the police when the actual answer arrives, and it arrives all at once because you know exactly how many payments you are behind. Because you know exactly how many payments you are behind, and you knew this was possible, and you had gotten pretty good at not thinking about it. Nobody calls first. In most of the country, nobody has to. This is the part that comes after the warning, and it does not look like a chart. It looks like a space where your truck used to be. Here is where things actually stand. 6.9% of subprime auto loans that were bundled and sold to investors were at least 60 days past due in January, the highest reading in a record that goes back to 1994. Subprime means a borrower with damaged or thin credit, and those loans get packaged together and sold as bonds, which is the only reason we can see this data monthly at all. It eased to 6.8% in February, which sounds like relief and is not, because January is always the worst month of the year for this number. The part that should hold your attention is not the record. It is the shape of the record. It is the shape of the record. January of 2025 came in at 6.56%. Car auction yard Ariel, and that was an all-time high when it printed. January of 2026 came in at 6.9. Each yearly peak is now landing above the last yearly peak. That is not a spike that resolves. That is a staircase. Industrial dark corridor staircase. Total auto debt in this country reached $1.71 trillion at the end of June, up $28 billion in a single quarter. In a quarter when total household debt actually went down. Every other major category shrank or held. Auto went up. It is now the third largest debt Americans carry, behind mortgages and student loans. And the New York Federal Reserve reported serious delinquency on auto loans, meaning 90 days or more behind, at its highest level since 2010. So how did the payment become impossible? Not one thing moved. 3 moved at once. The sticker price moved first. The average new vehicle transaction price reached $49,275 this spring. Then the interest rate moved. And then, to make those two survivable on a monthly basis, the loan terms stretched. 72 months became common. 84 months became available. A 7-year loan makes the payment work on a spreadsheet at the dealership, and it does something else that nobody at that desk explains out loud. It guarantees years of negative equity. Negative equity means you owe more than the vehicle is worth. On an 84-month loan, you can spend 3 or 4 years underwater, and while you are underwater, you cannot sell your way out, because selling means writing a check or the difference on top of losing the car. You are not a borrower at that point. You are a tenant with a title in somebody else's file. That trap is how a late payment turns into an empty driveway. Now look at who is paying what, because this is the number that made me stop. Average new car payments passed $800 for the first time this year, and roughly 1 in 5 borrowers is now above $1,000 a month. But break it out by credit tier, and it inverts. Borrowers in the non-prime band, credit scores from 601 to 660, average $811 a month on a new vehicle. Subprime borrowers average $792. That is more than the overall average. The people with the least room in the budget are carrying the largest payments in the country. because a worse rate on a longer term with a smaller down payment produces a bigger monthly number, not a smaller one. And the payment is only the entry fee. Insurance premiums rose, registration, tires, auto repair costs are up about 15% in a year, with the average repair visit near $840. And roughly 4 in 10 Americans cannot cover that with cash on hand. So the repair goes on a credit card, or the car sits, is a job that ends. Which brings up the thing economists actually watch here. People pay the car note before almost anything else, before the card, sometimes before the rent. Not because they are financially sophisticated, but because in most of America, the car is the job. And the daycare run and the grocery trip, when somebody stops paying the car, it is not the first thing that broke. It is the last thing that broke. Everything upstream failed months earlier, and you never saw it. Now, I want to give you the other side of this properly, because you are going to hear it, and you should hear it from me first. Subprime is a small slice of auto lending, somewhere around 15 to 17% of active loans.
Hey, real quick, if you're in debt and you're sick and tired of being in debt, I put together a program called the Dominate Debt Course to help thousands of people. Take a look at it. If you want this cycle of being in debt over forever and you want to own everything and you want to be building wealth rather than spending wealth, links down below. It'll blow your mind. And yes, it's way better than Dave Ramsey's program. Let's get back to the video.
Prime borrowers, the ones with good credit, are sitting at roughly 0.37% 60-day delinquency. That is not a crisis. That is a rounding error. Aggregate household delinquency across all debt actually improved slightly last quarter to 4.7%. And the Federal Reserve Bank of Philadelphia published a paper this spring asking directly whether these delinquency numbers overstate borrower distress. Their finding is worth your time. The stock of severely delinquent loans is rising, but the flow of newly distressed borrowers into that stage has been fairly stable, which suggests lenders are holding delinquent accounts open longer rather than a fresh wave of people falling apart. Every bit of that is true. And here is why it does not put me at ease. Auto originations hit a nominal record of $211 billion last quarter. And the Fed's own researchers flagged that the record does not survive an inflation adjustment and that rising vehicle prices explain most of it. Meanwhile, the subprime share of new approvals has fallen for 4 straight months. Lenders are already pulling back. That means the damage sitting in these portfolios is not from loans being written today. It is from paper written in 2024 and 2025, and that paper has years left to run. The tightening is the part almost nobody prices. When a lender takes a car back, they do not recover the loan balance. They recover whatever the auction pays. And after fees and reconditioning, that can land near 30% of the vehicle's value. Used values came down from their 2022 peak, and recovery values came down with them. So the lender eats the gap, then does the only thing a lender can do, which is tighten standards on the next applicant. The next borrower gets declined because of this borrower's loss. That is how one household's bad year becomes a whole tier of the country losing access to credit. Tricolor Holdings, a subprime auto lender, filed for bankruptcy last fall. That is a filing, not a rumor, and it is what the end of that chain looks like. There is one more thing, and it is the piece people learn far too late. When they take the car and sell it, you can still owe money. The auction price gets subtracted from what you owed, and the remainder has a name. It is called the deficiency balance, and depending on your state and your contract, they can pursue you for it. People find out that word exists about a week after the truck is gone. Voluntary surrender, handing the keys over yourself, does not clean that up either. It can look marginally better on a credit file, and it does not erase the balance. I am not going to tell you your rights because repossession law genuinely varies state to state, and I am not your lawyer. Read your actual loan agreement, not a forum post, and if it has gotten serious, a legal aid office in your state costs nothing to call. So here is the sort, and it is not the one you expect. It has almost nothing to do with your income. If you have positive equity, meaning the vehicle is worth more than the balance, you have an exit. You can sell it, take the difference, and buy something you can actually afford. You are exposed to inconvenience, not catastrophe. And depending on your state and your contract, they can pursue you for it. If you are underwater on a term longer than 72 months, you do not have an exit. You have a hostage situation. And your only real protection is cash reserves and time. And if your total car cost, the payment plus insurance plus expected repairs, is running past 20% of your take-home pay, you are already in the group this video is about, whether or not you have ever missed a payment. Go find out which one you are tonight. Pull the payoff amount, look up what the vehicle is actually worth, and subtract. Read your actual loan agreement, not a forum post, and buy something you can actually afford. You are exposed to inconvenience, not catastrophe, and buy something you can actually afford. You are exposed to inconvenience, not catastrophe. If you are underwater on a term longer than 72 months, you do not have an exit. You have a hostage situation, and your only real protection is cash reserves and time. And if your total car cost, the payment plus insurance plus expected repairs, is running past 20% of your take-home pay, you are already in the group this video is about, whether or not you have ever missed a payment. Go find out which one you are tonight. Pull the payoff amount, look up what the vehicle is actually worth, and subtract. It takes 11 minutes, and most people have never once done it. Somewhere tonight, a recovery agent is being handed an address, and the person at that address is asleep, and they have no idea it is tonight. In 2024, there were 1.73 million of those addresses, the most since 2009. Nobody loses the car first. The car is what they lose last. Economic Ninja is out.